In the world of business, there's this mantra you hear over and over again: grow or die. The idea is that a company has to constantly get bigger just to survive. And look, there's some truth to it. Companies that aren't growing have a hard time attracting top talent, and yeah, they often get bought out. But is that relentless chase for growth always the right move?
And that right there is the big question we're going to dig into. Because what if I told you that chasing growth just for the sake of it can actually be a massive trap? That getting bigger doesn't always mean getting better.
Okay, so let's get right into it. The wild thing is, for a lot of companies, the very strategies they use to chase growth are the ones that end up seriously hurting their long-term health. We're going to break down exactly how and why that happens.
This brings us to what you could call the growth paradox. It's this really counterintuitive idea that the moves companies make to get bigger can actually make them fundamentally weaker.
So what's the actual rule for creating value? Well, it all comes down to this one core principle. A company only creates real value when the money it makes from its investments, that's its return on invested capital, or ROIC, is higher than what it costs to get that money in the first place. Think about it. If your growth costs more than it brings in, you're not building value, you're destroying it, even if your revenue numbers are going up.
To really get this, we've got to pop the hood and see how the machine works. So, how do companies actually grow? Well, it pretty much boils down to three main engines.
First up, you've got portfolio momentum. This is just being in a market that's already growing. It's like having a strong tailwind pushing you forward. Second is market share performance. This is when you're actively stealing customers from your rivals. And third, you've got mergers and acquisitions, M&A for short. This is pretty straightforward. You just buy another company and absorb its business.
And this chart really nails that first point about portfolio momentum. Just look at the big picture here. You see that huge difference between an industry like biotech at the top and, say, utilities way down at the bottom? The key takeaway is this. Sometimes a company's incredible growth isn't about some genius strategy. It's just about being in the right place at the right time.
All right, so this brings us to the main event. If there are all these different ways to grow, which ones are actually the best? Which ones create the most value? It's time to lay out the hierarchy of growth.
And here it is, the pecking order. Right at the very top, the highest value stuff is creating whole new markets or bringing new customers into an existing one. Then in the middle, you've got stuff like winning market share from a rival. And what's at the bottom? Big acquisitions and just hiking up prices. Sure, they pump up revenue, but they often create very little real lasting value.
Let's think about a great example of high-value growth. When the first coronary stents hit the market, they didn't just improve a product, they created an entirely new product category. They solved a huge problem in a way no one else had. That innovation gave them a massive head start that rivals just couldn't copy overnight. That is pure value creation.
Now, let's flip that. A perfect example of low-value growth, think about the market for disposable diapers. You've got a couple of giants dominating it. If one of them slashes prices to grab a bit more market share, what happens? The other one instantly does the same thing. Any tiny gain is gone in a flash, profits get squeezed for everybody, and no real value is created. It's just a race to the bottom.
And this difference is crystal clear when you compare growing from within, or organic growth, versus just buying other companies. Growing organically, by building on what you're already good at, creates way more value on average. Why? Well, acquisitions are super expensive. You almost always have to pay what's called a takeover premium, which is extra money just to get the deal done. That automatically eats into your potential return.
And if you need proof, just look at the data. This chart says it all. When you sort companies by how they grew, the ones that grew the most organically delivered way better returns to their shareholders. I mean, it's not even close. The evidence is just overwhelming. Building is almost always better than buying. Okay, so let's say you've done everything right. You've found a fantastic source of organic growth. Now you've got another huge challenge. How do you keep it going? Because it turns out even the best growth stories have a natural expiration date. And the reason why is perfectly captured by this shape, the S-curve. Almost every product or service follows this path. You have a slow start with the early adopters, then this phase of explosive growth in the middle, and then eventually it flattens out as the market gets saturated. And you see this S-curve everywhere in the real world. Just look at Walmart. They had an incredible run of high growth for more than 30 years before they finally hit that plateau. Now compare that to eBay. Their growth was even more insane, but because it was all digital, they hit maturity in just about a decade. The big takeaway here is that these life cycles are getting faster and faster.
So this creates a huge problem that researchers call the portfolio treadmill. Just imagine you're a $10 billion company. To grow at just 5%, you need to find $500 million in new business this year. And as your existing products mature and flatten out, you have to keep finding these massive new hits just to keep from shrinking. You're basically running faster and faster just to stay in the same place.
And this chart, well, it shows the brutal reality of that treadmill. See that top line? That's the fastest growing companies. Now look at how steeply it just plummets. In only a few years, their amazing growth rates fall right back down toward the average. High growth is like a rocket. It just doesn't have enough fuel to stay in orbit forever.
21%. Just let that number hang in the air for a second. 21%.
What is that? Well, that's the tiny fraction of companies growing at over 15% a year that were still growing that fast a decade later. The point is, being a high-growth superstar is almost always a temporary thing. Sooner or later, gravity kicks in. It is absolutely the exception, not the rule.
So, after all of that, what's the big takeaway here? It's not that growth is bad. Not at all. It's that we have to get a lot smarter about it. It's about growing smarter, not just bigger.
So, let's boil it all down. First, how you grow matters so much more than how much you grow. Second, the most valuable growth comes from innovation, from making new things. Third, be really skeptical of growth that comes from giant acquisitions. It's often a sign that a company has run out of its own ideas. And finally, always remember, sustained, crazy high growth is incredibly rare.
So the next time you see a headline about some massive merger, you can ask the right question. Is this a bold move from a company that's strong and confident? Or is it a desperate attempt to stay on that treadmill, buying growth they just can't create for themselves anymore? Now you have the framework to figure it out.